Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, December 15, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And in fact, the Spider issued a dividend today, so it's not reflecting, meaning the price and the chart is not reflecting the true move of the S&P 500 today. So what I'm going to do is I'm going to use a cash index SPX chart tonight, and now you can see that we're at fresh closing new highs today on the S&P 500. So following yesterday's slight dip lower, the S&P turned around today. In fact, all the markets turned around today and powered forward. This was quadruple witching options expiration week, and therefore quadruple witching options expiration day. And it's an after the fact, it's a Monday morning quarterback thing, but we've seen this over and over again. I've seen this over the years. We've discussed it here many times where when you have an options expiration week, in fact, I believe we talked about it earlier in the week, or at least late last week, how the options desks at the big institutional banks and investment banks, what their job is to make as much money as they can this week. This is the week when they get paid. And to add insult to injury, it's a quarterly expiration, which makes it quadruple witching options expiration. That means that 4 asset classes, their options were expiring this week. So it adds an extra layer of what normally is volatility, but in today's case, this was what we call a rip your face off rally in the face of people and whoever they were that shorted the market on the way down yesterday, thinking that the market was going to continue lower, and therefore they got their face ripped off. There was a lot of short covering that went on this morning, and the buying begets buying. It becomes a self-fulfilling prophecy, and the market trended higher all day long. Here's a 10-minute chart, and just in the face of market going higher all day long, I just want to point out that the last 20 or so minutes of the trading day, the market did dip down a little bit, and that has to do with the rebalancing that goes on in the indices, and stocks are coming out of indexes, stocks are going in, and therefore you get a ton of volume hitting the market in the last several minutes of the trading day, let's say the last half hour of the trading day, as they're rebalancing the indexes, and that's part and parcel to the quadruple witching options expiration week. So let's talk about where we go from here. We're now again getting extended one more time from home base or the 20-period moving average. That doesn't mean we can't go higher. Let's discuss where we are as it relates to the time of the year and what the expectations are. Leading into next week, the volume's going to start getting lighter and lighter. There's going to be less and less market participants in the market as we get from this point forward through the New Year's holiday. It's a little early right now, but maybe the Santa Claus rally came a little early this year, or maybe we just rally into the end of the year. It's hard to say right now. It's not anything we need to be concerned with. What we do need to know is that this is a bull market. I have said that time and time again. The trend is your friend until the very end. Pullbacks are meant to be bought. We're not shorting this market. We never were shorting this market. Way back, even into the summer, we had a cycle top in the summer, and that only played out for a couple of weeks. And beyond that, once we closed above that high, that was it. The market has gone higher ever since. And the top I'm talking about was right here. We identified an area where we said there was going to be a cycle top, and there was a span of about 4 or 5 weeks long that I said, look for a top in this area. And all we did was come down to here, and then the market took off and never looked back. So when the market broke above this high, we're not shorting the market anymore. The trend is your friend. And when the trend is up and the volume overall, almost each and every day, is relatively light in comparison to historical averages, there's no reason to be short this market until we close below certain levels. And that really never happened. We identified some along the way, but the market, it hit a few, but it never closed below certain levels, and therefore we kept saying it over and over again, the trend is your friend until the very end. Now, look where we are in the S&P Cash Index. We're 2,675. Can the market get to 2,700 before the end of the year? Of course it can. It's not that far away. It might have seemed a lot farther yesterday, but today it's a stone's throw away. And I'll tell you that there is a likelihood. In fact, in my mind, there's a pretty decent probability that we will get to 2,700. We may come up a couple of points short. They may come up to 2696, 2697, in that neighborhood and come up short, or they may pierce through it a little bit, but there's definitely going to be a natural area of resistance around that 2,700 area. But can they do it before the end of the year? Absolutely, they can do it before the end of the year. Just to add a comparison, which we never do, but let's talk a little bit about the Dow Jones Industrial Average. Obviously, the chart looks very similar. We're at new highs. The trend is up. We are overextended, but we're at 24,651. Can they hit 25,000 before the end of the year? Yes, they can. Will they? I think they'll try. Whether they get there or it happens in the first part of January, we're going to hit or at least come very close to 25,000. That's just the way this works. It's too much of a big fat round number for it not to at least come close, if not pierce through it by a little bit. Let me explain some of the psychology behind what goes on in the markets. And this is not anything to do with the individual investor. This has to do with the institutional money managers, the hedge fund managers, the mutual fund managers, all the professional money managers, the investment banks, the global banks, everybody on the institutional side of the house. Their bonuses are dependent on returns. They're not going to let the market fall out of bed between now and New Year's and let some of their bonuses go by the wayside, okay? So the money managers are going to ensure that the status quo happens, that everything remains, at least for argument's sake, where it is, if not higher. It's going to be very easy with the sentiment where it is to drive the market higher. We're in a euphoric state, and it's very easy into the end of the year for that euphoric state to continue at least for another 2 weeks, if not into the first half of January. At this point, the only thing that can derail this market and the euphoric state is a black swan event, something we obviously can't see coming. It has to be something of a big magnitude, geo-global politics, something with North Korea, something really terrible would have to happen to derail this market at this point in time. Obviously, we can't see a black swan event coming. However, we hope it doesn't come because that would harm everybody. But the reality is the likelihood of the market at least floating sideways to higher into the end of the year is more likely than not. Let's take a gander over at the IWM, and I'll show you something interesting. Now, technically speaking, this is still a bearish pattern, okay? But it was a tremendous day for the IWM, up 1.6%. But technically, this is a bearish wedge pattern, and these will generally play out to the downside. But everything I just discussed about between now and the end of the year holds true, and it's going to hold true for all the markets. But let me point something out that's interesting to say the least. Number one, we're above the upsloping trend line that we dropped below yesterday for a split second, or at least one closing session on the daily chart. Now we're comfortably above that line again. It's important that they close the month of December above that line to keep the long-term bullish uptrend intact for the IWM. But what I want to point out is the high from yesterday comes in at 152.20. They closed the IWM today at 152.24. We were a lot higher earlier. In fact, we even took a run at the next red candle high up here. Okay, we pierced through it, but we're not able to close above that today. Can they close above that between now and the end of the year? Absolutely they can. But what I wanted to point out was the fact that we closed above yesterday's high is important, and here's evidence of the fact that it really has more importance than might meet the eye. We sold off the last half hour of trading like we did in all the markets, and that had to do with the indexes rebalancing and quadruple witching options expiration that we talked about before. But that being the case, on the way down, they had every opportunity to close the day below that 152.20, the high from yesterday, and you can see here the low, let me move this over, the low today happened to be 152.18, and that was in the last candle of the day, and then just in the last few minutes of the trading day, I'll even bring up a 1-minute chart, and you'll see here that in the last 2 minutes of the trading day, they ripped the market back up to make sure that we closed above yesterday's high. Now, that might not seem important to the naked eye. It might not seem important to the layperson. To a technical analyst, it is very important, at least the way I read the charts. A close above yesterday's high is a sign and at least an initial indication of more bullish behavior ahead. Now, in fairness, the IWM does not look the same as the S&P 500 or the Dow or the Nasdaq at new highs. It doesn't look the same. It's not obviously at new highs. However, we did work off some of the overbought condition, and there's nothing that says that this market can't power forward and make new highs. When you look at the weekly chart, there's nothing wrong with this market. We had one down week, and we can easily recapture that, whether it's between now and the end of the year or into January. That certainly can be recaptured. But what I want to point out, and what's ultra important, is the long-term uptrend is still intact on the weekly chart for certain, so there's nothing technically wrong with this market. The daily chart certainly doesn't look the same as the others. However, technically speaking, this is still in a long-term bullish uptrend. One of the things that you have to realize why the IWM may look different or does look different from the other charts is because the IWM is small cap index, and it represents small business across America. And part and parcel to the reason why the IWM, in my opinion, was struggling of late was because of all the discussion in Washington about the tax bill and what it's going to entail and how much it will or won't help the individual, small businesses, corporations, the whole gamut. So I think some of the fear in the market was, will the tax bill pass? And if it does pass, is it going to contain enough relief for small businesses to continue small business in America powering forward? And I think that's one of the reasons why over the last couple of weeks we've seen a decline or at least a pullback in the IWM as it relates to and directly related to, in my opinion, the tax relief bill that is now moving through Congress, and apparently they do have the votes to pass it. We're going to find out more, I think tonight even, and I'm making this video before the official announcement, but we're going to find out more, and if it does pass, if they do have the votes, I think the president is going to sign that bill before the end of the year, most likely into next week, and that'll be a nice Christmas surprise for everybody. I know some people don't believe it's enough tax relief, and some people believe it does. I'm not making an opinion one way or the other. I haven't read the bill. I don't have an opinion. Either way, it's not going to move the needle for most folks. I think the reality is it's more psychological than anything else. But if it does move the needle for big business and it does move the needle for small business, then that can help the market at least in the near term. The transports today finished up 65 points. They were up more earlier, but again, the transports are still, even yet today, even after yesterday's pullback, they're still in an overbought condition. So it's not going to be out of the ordinary if the transports just go back and forth for another few days, letting home base or the 20-period moving average come up into price. Discuss that all week long. The transports are severely overbought, but when you look at the weekly chart, I like to do this on Fridays because it's the close of the week and it gives you a clear picture of where we are from a longer-term perspective. When you look at the transports, they're A, severely overbought, but B, in a massively bullish uptrend. So even if we came down a little bit to work off some of the overbought condition, there's nothing that says that this bullish uptrend has to end anytime soon. In fact, the big picture is, obviously we can have corrections and we can have pullbacks along the way. Even though we barely had one this year, we can have one next year, but the bullish uptrend really doesn't have to end anytime soon. We can have another year or two of this bull market with corrections along the way, but the corrections can be 3, 5, maybe even 10%, but that doesn't mean that the bull market has to end anytime soon. We could actually have a bull market for another couple of years before this is all said and done. So all in all, no new information on the transports. We can move it along. Tonight I want to take a look at the Nasdaq market. We'll use the triple Qs as the proxy. Sometimes I use the NQ or the futures contract, but tonight we'll use the triple Qs. Pretty obvious. And here's a good example of some of the things that I like to discuss and teach on an ongoing basis. So we had this breakdown candle. There's two breakdown candles. There's two big red candles here. The high of this red candle was 155.63. And on this day, when we closed above that level, that was the initial sign or the tip-off that the downtrend was over and the market was going back to the upside. We had another hurdle to get through. We had to get through the next red candle high where we consolidated for a couple of days. And obviously today, we just powered right through it. And now we're at new highs. Certainly, we'll get pretty quickly back into an overbought condition, but markets can, just because I bring that up all the time, doesn't mean the market has to come back down. When I say that, the market can go sideways or the market can stay overbought for longer than most people realize. Markets can go a lot higher than people believe they can, and they can also go a lot lower than people believe they can before correcting back to some kind of a mean reversion. In this case, we have a closing high. That's bullish. The likely scenario is we get more bullish behavior into next week. We could obviously get some backing and filling, but everything I said before holds true about between now and the end of the year. There's no reason that we have to see a decline minus some black swan event between now and the end of the year. Looking at the gold market, we took a run for the spot we discussed last night, which is the red candle high, and I'll point it out right here. This red candle high, we took a run for that. We didn't quite get there today, backed off of it a little bit, but again, we did get some follow through. This is likely a bottom, at least for the time being. The likely scenario also is we'll probably get some kind of a retracement or a retest before going higher. And that would essentially give us an ABC pattern. A leg was from the bottom up to the top today, for example, or another top. We could get a B leg, which is a partial retracement of that move. And then we get a C leg, which completes officially when we get above the high of the A leg. That's the likely story that we see in the gold market. There's a nice juicy gap that needs to be filled. That gap comes in at $1,248, spot 60. We could certainly fill that gap next week. And if we do, that could complete a B leg of an ABC pattern. That's what I think is developing. It's a little bit premature to say that right now, but I have a hunch that's what's going on. We'll see how it plays out into next week. When you look at the silver market, we had a nice big healthy day in silver today. Silver probably also put in at least a short-term bottom, and we have higher prices coming in silver. The next natural area of resistance for silver would be this red candle high, which at the time will likely coincide with some overhead resistance from the 20-period moving average sloping down into that level. If we get up there in the next couple of days, you'll definitely have some resistance there. If we go sideways for a while, then the market would be building energy to potentially get through that area. Crude oil, another update today, up about 0.5%, right into the 20-period moving average again. We hit it yesterday for the most part. We closed pretty much right on it today. And likely scenario is if we can get above the 20-period moving average, we can maintain and resume the uptrend that has been prevalent in crude oil for quite some time. We never came down to this trend line. We never tested the double bottom. We came close yesterday, but we didn't quite get to this double bottom here, and we certainly didn't get to the $55 area. If we get above and close above the 20-period moving average, that'll be the first indication and the first sneak peek at more upside coming in the crude oil contract. Might as well give a little chart lesson while we're here. Looking at the 60-minute chart of crude oil, and it doesn't matter that we're looking at crude. This could be anything under the sun. Could be a stock, could be another commodity, could be a market index, doesn't matter. What we have here is an up move, and then we have a long sideways consolidation pattern. And generally speaking, this is going to promote another move to the upside, okay? And likely scenario is you'll get an equidistant move before running into major area of resistance. And what else was going on here is that we were consolidating in and around beneath, we got above it a few times, but beneath the 100 period moving average. Now the 100 period moving average on this chart is a 100-hour moving average on the hourly chart. This is a 60-minute chart. But you can see here that we're basically going sideways, building energy to get through this area for the next area of resistance, which is going to be this area. You have a pivot top here with a red candle here, the high of the red candle. So I'll point out where the natural areas of resistance are. You have a red candle high here. That's a natural area of resistance. You have an area here that also is the same as this red candle high. Okay, so these are natural areas of resistance, and this is an hourly chart. So we may stall out here during the day, but this is not a daily chart, so this isn't really prevalent on the daily chart. But the next real major area of resistance, if we can get through those areas, is back up at the 5840, 5850 area. But the point I wanted to make was that this is a bullish pattern on the hourly chart. When you go down to a 10-minute chart, you can see much of the same thing. Now, I want to point out basically what's an inside bar pattern. Okay, so you have this up move here, this green candle, and now you're going sideways, building energy for another move higher until and unless, let me wipe this out, until and unless we close any 10-minute candle below this level, then this pattern is intact. Whether this is a 15-minute chart, a 10-minute chart, an hourly chart, a daily chart, the same rules apply either way. If you close below this big green up candle on this 10-minute chart, then that takes this bullish pattern off the table, and you have to look to what else you might have on the chart, whether it's on the 10-minute or the hourly chart. I always like to go up to an hourly chart to see the bigger picture, and then the daily from there. But on this 10-minute chart, you can see until and unless we close below this level here, the bottom of this green candle, this is a bullish 10-minute chart telling us that price wants to go higher. And you can see on the 10-minute chart, we're above all the moving averages. This is bullish behavior. This is telling us that crude wants to go higher on the short-term chart. And we took a look at the hourly, and we also took a look at the daily, and they all kind of match up. They're all telling us the same picture, that crude is in an uptrend. Bonds. We've been talking about bonds for a long time. I've been pointing out this extra important level at 153.22. We had the close above that level, then we had the rope-a-dope down. We got to that level the other day, closed above it yesterday, and here we are closing above it today. And in my book, the way this works for me is this is confirmation that we're going higher. A close above yesterday's high. Yesterday we closed above this level for the second time, and today we're going to get a close. Well, we may not. The market's officially still open. If we get a close above today's high, and yesterday's high, pardon me, at 154.6, if we close above that level, that will be confirmation that where higher prices that I've discussed are coming. And those higher prices are all the way up here at double top. Whether it stops at 157 or we go up to 158, we'll be looking for, at that area, a sign of a reversal, a signal of a trend change when we do, and if we do, get up to that area. Can you trade the bond market long to that area? Yeah, it's pretty simple. If you get a close back below these moving averages, all bets are off. The first indication that I'm wrong would be a close back below 153.22. But as you can see, we already had a close above it. We had the rope-a-dope down. I don't really expect a close back below it. It could happen, but you can be long the bond market, and you can do that with a TLT, for example, which is the exchange-traded fund that tracks the 20 and 30-year Treasury bonds. You can be long looking for this 157, 158 area. It might take a month or two to get there, but I think they're going to get there. The longer-term picture is bearish, but that's the very long-term picture. That's the multi-month, multi-year picture. In the short term, for the next, let's say, 1 to 2 months, I think this picture is bullish, and I think we go to double top. In the dollar, The dollar seems to be playing out the pattern we discussed last night, which is an ABC pattern. We had the A leg up, we had a B leg that looked like it was going to break down, but we never closed below or even touched the 100 period moving average, so this is still intact. And now we're on the way back up, and if we get above the high of the A leg, that will officially complete the pattern, but we have an area up here that we'll likely get to if this is in fact an ABC pattern and we are in the midst of a C leg, and then this will likely coincide with the 200 period moving average sloping down into this area at the time in which we would get there. That would provide overhead resistance. So this area right around, let me get the exact number, right around 94, let's call it 94.60 to 94.70 would be overhead resistance for the dollar if we do continue higher. The first order of business is we have to contend with this breakdown candle at a high of 93.70. Any close above that level, and we're on the way to the levels we just talked about. And with that, it's everything I wanted to and intended to discuss tonight, so I will give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.